Look, Bill, it's pretty hard to look past the precious metal space right now.
Oren Resources is a junior exploration company with the appetite of a major, focused on finding the next globally significant discovery to create enormous potential upside for shareholders. It's one of the most aggressive exploration companies pursuing high-grade, scalable gold and copper deposits, and has a premier 7-project portfolio including its 2 flagships, Committee Bay in the Arctic and Sombrero in Peru. With Oren's unparalleled technical team and highly experienced management with a history of success in advancing and monetizing exploration assets, Oren has been called one of the best in the junior exploration sector. Oren trades on the TSX and NYSE under the ticker AUG. To learn more, go to OrenResources.com. That's AURYN Resources.com. Welcome back, ladies and gentlemen. Thanks for tuning in. I'm Bill Powers, your host, and this is Mining Stock Education. Well, it's been about 6 months since I had Sam Broom, the investment executive with Sprott Global, on the show, a very popular guest. And for the last 2 years, every 6 months, I check in with Sam to get his thoughts on the market and to keep us, especially as North American investors, informed as to what's going on in the Aussie mining markets. With that being said, Sam, welcome back to the show.
Bill, thanks for having me. As always, it's a pleasure.
So you work with individual clients. You're a full-service broker. Regarding private placements, I'd like to start by getting your perspective on what you're seeing with private placements in the mining sector right now.
Yeah, sure. So private placements are quite an interesting way to play, in particular, the junior exploration and development space. For those of you that aren't as familiar with the private placement market, you have to be an accredited investor to participate. So in the US, that means having $1 million net worth excluding the family home, or over $200,000 in annual income. There are a bunch of other rules, but those are the 2 main ones that people usually qualify by. Right now, it's quite an interesting time to be considering private placements. In general, we've seen a strong lull in private placement activity over the last 6 to 12 months. It's been pretty quiet out there. For any of you that have been investing in the junior space will have noticed how slow the junior markets have been. As a consequence of that, the private placement activity slows right down. But for a buyer, if you're a allocator of capital during these times, it's actually the time you want to be considering being the most active. The reason being is there's just not the capital out there to fund these juniors through these private placements, which means that the ball is in your court when it comes to dictating the terms for these placements. So oftentimes, you look at the warrant terms. So the warrant is a sort of a quote unquote freebie that often comes with these, not always, but often comes with these placements. The best one you can get is usually a tradable 5-year full warrant, and those are quite rare. But you'll only really see those at market bottoms where there's really very little interest. Now is the time to keep an eye out for those kind of placements, because you just don't get those coming along when things are hot. I do think what we'll see in the next 6 to 12 months, particularly in the gold space, if this breakout in the gold price holds up, is we will start to see a whole host of companies sort of coming out from the darkness, so to speak, and out of hibernation and raising a bunch of capital. So you do want to be selective, because what that also does is it increases the supply of stock in those juniors, in the sector. So it often puts a little bit of a cap on the sector in the short term as that glut of refinancings and recapitalizations occurs. But if you can pick out the very best ones, and you do have to be very selective, there's a lot of crap out there in the junior market, to put it nicely. So you really have to know what you're doing. And even if you know what you're doing, the junior market is an extremely high risk, high reward proposition. But if you were able to effectively play that junior market through the private placement game by building a big warrant bank over time in high quality exploration companies, the goal is that, let's say you have 10 to 15 private placements, and you accumulate these warrants. You'll have a couple of them which will really hit a home run, and you end up getting paid twice with these warrants. So right now is a really good time to be starting to take notice of the private placement market. If you're an accredited investor, I do think we're about to emerge from a fairly dark time for the junior financing sector, the junior financings for the junior sector. So it's definitely time to keep your eyes peeled for really good deals. And if you are an accredited investor and you haven't thought about playing the junior space, it's definitely time to take note. And if you do want to chat more about it, I'd obviously be more than happy to give you more information about how you can go about doing that.
When you're surveying the investment scene for explorers and you're advising your clients, what are you looking for in terms of what the explorers have in their treasuries right now? Things are very tough. I just read today a company announced we closed our private placement, and then I clicked on it and read it, and it was like for $250,000. And I'm thinking to myself, I don't even think that's going to get you through the year with all the listing fees. What are the minimum requirements in the treasury that you'd like to see?
Well, it depends. You really want them to be raising enough to make a material difference and to steal a Rick Ruleism, to answer an unanswered question. I want to see that they don't have to raise money for at least another 12 months, ideally, and that it'll give them enough money to undertake an exploration program that's really going to provide an answer. So let's say they've developed a decent target. They've got geophysics that has a robust anomaly that's supported by soil sampling, the mapping. You've got a drill really target that requires probably 5,000 meters or 2,000 to 5,000 meters to test the concept. You want to make sure they've got enough money to drill that out and then have enough in the bank to cover G&A, so they're not going to be having to tap the market again for at least another 9 to 12 months. If they're just doing a keep the lights on raise, like you said, $250,000 to pay the listing fees and keep the office and management salaries ticking over, it's a clear avoid for me. You really have to make sure that you're getting some bang for your buck, because that's what you're there for. You're not there to pay directors' fees and management salaries.
You have a keen interest in charting and other forms of technical analysis. From purely a technical analysis, throwing out the fundamentals of supply and demand, what commodity are you most bullish on just from a charting perspective?
Look, Bill, it's pretty hard to look past the precious metal space right now. For a couple of years now, I've been posting to my clients, and I believe I've even posted it on with you on one of these podcasts before. The precious metal, the gold price in particular, has been building a 5 to 6 year basing pattern that looks extremely powerful. I thought it was going to break back in 2017. It didn't. It teased us one last time. We had a big sell-off through sort of the early to mid last year through until about October. We have finally now broken out above that level that everyone was waiting to break at 1375. We've even, broke through 1400 momentarily. Things are pulling back a little bit now, but I can't look past the gold chart at the moment. It looks fairly enticing. I don't say these things lightly, because you never know in this space. No matter how good a chart looks, no matter how good the fundamentals look, things change overnight. Money flows reverse, and you can be whipsawed. We all know, being precious metals investors, how quickly things can change. But on a purely technical basis, I haven't felt this excited about the technical and the fundamental as well. But we're talking technicals here. So to me, the precious metals space, and with gold in particular, looks extremely interesting here. It wouldn't surprise me if we consolidate. In fact, I'd almost prefer if we consolidated and went sideways for a few weeks to a few months, even down to 1350 on a purely technical basis would be fine by me. But if we can hold those levels and we can go sideways for a few months and build a base for the next move, the chart is one of the better looking charts, not just in the commodity space, but of all the indexes and ETFs and sectors that I follow. It's hard for me to look past the precious metal space right now.
I'm looking at the cobalt price. Cobalt, this chart tells me, is $13.38 US per pound. A year ago, it was about $35 a pound. And a few years ago, you were one of the first on the internet, at least on YouTube, to produce a video in which you talked about the bullish outlook for cobalt. What's your perspective on cobalt right now?
I sort of went a little bit colder on cobalt. There was a reasonable supply response out of the artisanal miners out of the DRC to the price spike that we saw. So we saw a glut of kind of dark pool, if you want to call it, cobalt coming out of the DRC. We also, in hindsight, we probably saw a little bit of euphoric buying. You saw a lot of big transactions. You saw the big stream that Wheaton Precious did on the cobalt space. We saw the Cobalt 27 company come into existence. There was a lot of, with the benefit of hindsight, probably overexcitement and euphoria in the cobalt space that has now since reversed, and it's been a complete popcorn trade. To be honest, I'm far more interested in it again now on a purely theoretical basis, because it is right back at that, almost back at the starting point, and it is going to be a critical element in all the electrification technologies. Assuming lithium-ion batteries continue to remain the main energy source for electric vehicles. I probably have. There's not a whole lot of high-quality ways to play it. There are a few speculative avenues to play it. Again, I focus on those, the cobalt in safe jurisdictions, mainly Australia. But that all the plays that I'm aware of are firmly optionality, and they're really nickel deposits with a decent side of cobalt. So, on a different note, I'm far more interested these days in the nickel side of things. And if I can get a little bit of cobalt for free on the side, that's kind of the way I'm playing the cobalt theme these days.
You mentioned the Aussie market. As North American investors, what should we know about what's occurring in the Aussie mining markets right now?
So, I was looking back through some of our old emails, Bill, and I've been a huge fan of the Aussie market for a number of years now, for a whole host of reasons. It continues to be, particularly in the precious metal space, but in general, I would argue the premier mining market in the world, which is strange because most North Americans wouldn't be able to name you a single Aussie mining company. But it continues to go from strength to strength. I'm just looking at some numbers now. Year to date, I'm looking at the Australian All Ordinaries Gold Index, which is kind of like the prime index that tracks, I think it's about 20-something Australian gold miners. It is handily outperformed in US dollar terms its international brethren. I'm looking year to date, it's up 28% versus 21% on the GDX, 19% in the GDX. I'll say 15% on the GDXJ. The the TSX Global Gold Index is up 19. So, it's given the dollar, the Aussie dollar and the Canadian dollar have been relatively similar. You've seen literally a 50% outperformance from the Aussie index this year in terms of the gains they've had. So there's one key thing that's driving the Aussie gold mining market, and that is margins and robust balance sheets. There is very little debt on the Aussie producers relative to the North American markets, which makes it far more institutionally investable. The margins are fantastic. I mean, if you go and look at the all-in sustaining costs in US dollar terms for most of these Aussie miners, most of them are definitely sub 800. Some are even sub $700 US all-in sustaining costs. So they've been a conservative way to play the gold space for the last few years, during a time when the gold space has been a really tough place to be. It's a completely different business model, but if you look at the North American space, the only ones that have done well have been, well, not the only ones, but the bulk of the names that have actually done well in a tough market have been the royalty streaming companies. Different business model, but similar reason why they're doing well, in my opinion. They're proven to be businesses that have been able to prosper and make money and generate decent return on invested capital during the full range of the cycle prices. So that's why I continue to like the Aussie space, especially the precious metal space. Less of a Aussie dominance in my client portfolios outside of, in the base metals. I tend to have more North American exposure in the base metal space. But if you're looking at the precious metal space in particular, if you don't have, a handful of the better Aussies in your portfolio, you really are missing out, and you really should take a close look at it and consider the best ones and adding them to your portfolio.
And some of those well-capitalized Aussie miners, such as South 32 and St. Barbara, have been shopping for mineral deposits in North America, haven't they?
Yeah, we've seen a fair decent whack of the the Aussie takeover, or however you want to term it. I think that may continue. I think there's been a little bit of over exuberance. I've seen a lot of speculation trying to find the next takeover target, particularly in the gold space, following the Santa Barbara thing with Atlantic Gold. And kudos to Stephen Dean and his team. That was an absolutely fantastic deal for them. What we've seen is in the gold space anyway, the miners that have been taken out by the Aussies have been producing assets. And I think a lot of people have rushed to the next development stage project thinking that it's going to be a takeout target for an Aussie. I could be wrong, and you might see that happen. But I think that the trend of buying producing assets is going to continue. I'm also cognizant of the fact that the Barracks and the Newmonts are going to be spinning out a lot of assets, non-core assets soon, in the next 12 to 18 months. And I think a lot of those are going to be prime targets for these cashed up Aussies. So I'm not 100% sure that we're going to see a huge glut of juniors continue to get taken out, or sort of smaller to mid-cap producers. There are a couple I've got my eye on that I think might be in the works. But in general, I don't think we're gonna see a dozen or so takeovers in the next 12 to 18 months. I think it might be one or two, if that. So look more at the asset quality and where it is in terms of being in production versus development. I think that's where you need to focus.
Trilogy Metals is a world-class developer in Alaska's Ambler mining district. The company already possesses 8 billion pounds of high-grade copper, 3 billion pounds of zinc, over 1 million gold-equivalent ounces, and over 77 million pounds of cobalt. Trilogy's Arctic project boasts an after-tax net present value of $1.4 billion, with a 33% internal rate of return. Trilogy is led by an experienced management team with proven success in discovering and developing projects in Alaska. The company is well-capitalized, has no debt, and possesses strong institutional support. Trilogy trades in New York and Toronto under the ticker TMQ. To learn more, go to trilogymetals.com. That's trilogymetals.com. Sam, what's your take on the U.S.-China trade war, and how should speculators play this?
It's a tough one. I was looking at some economic data today, the PMI indexes and the ISM and things like that, mostly for my industrial metal themes that I look at. Some of the data is pretty scary looking. So we've got this dichotomy in the industrial metal space at the moment where, you look at zinc, for example, you've got near record low inventory levels in the LME. Nickel, for example, you've got inventory levels falling off a cliff, and that's only starting to happen at an even increasing rate, accelerating rate, I should say. So on the supply side of things look tight. We're looking at TCRC rates and smelter costs going through the floor, which in the copper space, which signifies that the copper markets should be is apparently tight, and yet we've got continued weakness in the copper space. So we're getting this real conflicting information with things looking tight on the one hand, but prices still staying weak or even getting worse. I'm a little bit cautious at the moment. What I am doing personally and for clients is continuing to slowly average into my very highest quality picks. I think the thing to do right now is to accumulate quality on dips. Every time things dip, you want to be buying your quality names. I'm not worrying too much about trying to speculate on the next, 20 bagger, lead zinc discovery. Although to be fair, not one of my largest speculative position at the moment is actually a zinc play, but that's more to do with the deposit quality rather than it being a zinc play. But what I think you should do is you should be looking to average over many tranches into your best industrial metal plays while this trade narrative is in place and driving weakness in those markets. Don't do it all at once though, because things could get worse before they get better. That is, if I had to bet, I would say the industrial space may get worse before it gets better. But in the long run, the supply side is looking extremely bullish for if and when we know it's going to happen. The demand side of the equation, i.e., China stimulates next, or heaven forbid we have a major reset and the governments all come in with these infrastructure stimulus programs and things like that, which I'm almost certain is going to happen eventually. So you want to have your quality portfolio accumulated and ready to go on these weaknesses. So
one thing that you and I have talked about, and then I have observed some questionable things in my opinion with some companies, is change of control fees. What are your thoughts on change of control fees in this sector? And can you give us an international, for those of us that are based in North America, can you give us an idea of what different mining markets across the world do with these things?
Yeah, sure. It's obviously a big topic at the moment, and I think rightfully so. I think some of the payouts that management and directors have received from essentially completely destroying shareholder value during their tenure is a slate on our industry. And I know it's not just our industry, but it seems to be rather prevalent in our industry. This is another reason why I strongly prefer, well, I shouldn't say strongly prefer, but I have a soft spot for the Aussie market, and it's that they have a extremely strict set of rules on what companies can pay out in terms of a golden handshake or a change of control clause payment. For example, directors can only receive 12 months base salary as a change of control clause before shareholders have to approve it. So it's basically the Wild West over here in North America. They can get paid whatever they want, and it's up to shareholders to revolt if they want to make change. Another thing is in Aussie, it's not directly linked to the change of control situation, but they have this thing called a 2 strikes rule, where if any compensation report gets more than 25% no votes at the AGM for 2 years running, then all non-executive directors are up for re-election. So it basically holds management directors' feet to the fire and makes sure they're not basically hooking themselves up at the expense of shareholders. It gives shareholders a lot more power, and I think I would love to see more regulation. I'm not usually a fan of regulation, but in this instance, I would love to see some sort of changes put in place to make the situation more tenable over here and help shareholders hold management accountable here in North America too.
Is part of your due diligence process researching what the change of control fees are before you invest in a company? Do you analyze all that? Absolutely.
I personally do it. We've got a really, really good group of people here at Sprott. We've got one guy in particular called Neil Adshed, who's fantastic at, he's just got an interest for finding the nitty-gritty details of contracts and things like that. So we always go in and look for the minute details that most people don't even bother looking through, the 20 to 30 page document to find the who's going to get paid what if a change of control happens, or the various forms of compensation or kickbacks that management or directors are getting. It's really, really is important to dig deep when you're making an investment and make sure you know what you're getting yourself into and know what the incentives, because that's what it all comes down to, right? You want to know what the incentives management have to make the company succeed, and you want to make sure you're investing in companies where the management team have exactly the same motivation and incentives as you, the shareholder. And There are always exceptions to the rule, but more often than not, you'll find the best companies, the best performing companies, are companies where the shareholders and management have the same incentives. So
it seems like there could be some guiding principles about not having these excessive control fees if the executives at the helm of the company, have basically destroyed share price valuation over the last, let's say, 2 years. If there's just some guideline that if the share price is down more than 45% in the last 2 years, it negates the $15 million change of control fee. I'm just kind of thinking out loud, but it seems like something like that could be implemented.
Totally. I mean, you'd have to have a hard think about exactly how you do that. But as it stands at the moment, I mean, if you have a management team that owns very little to no shares, they're going to bank out like a bandit and claim millions of dollars if the company gets bought out. In a perverse way, they're incentivized to destroy the company's value to the point where it becomes more attractive to an acquirer, because that management team then, the change of control clause is triggered. They make out with their giant fee, while shareholders are left with 20, 40, 50, 70% loss or whatever it is. So I never like to see that. I always like to see management, making out either handsomely or poorly, just like our shareholders. So, looking at what their compensation is, looking at what their change of control clauses are, and looking how much stock they own is a hugely important part of our investment thesis.
You've been listening to Sam Broom, an investment executive with Sprott Global. Sam's email is sbroom@sprottglobal.com, and Sam advises and can help you if you're interested in a full-service broker. And there's a team there at Sprott, as Sam referenced, that does the due diligence and the research on the companies that Sam recommends to his clients. Sam, is there anything else you'd like to say about how people can contact you?
Yeah, just if you do want any more information, contact me at that email. You can also look me up on the website and click on my link in our people link. I'd be always more than happy to talk to you. I know Rick always offers to give a complimentary ranking of people's stock portfolios, so I'm always happy to do that as well. I'd be more than happy to look at your portfolio and give you an obligations ranking as well. So if that interests you, please feel free to reach out to me.
Excellent. And don't forget, the Sprott conference is coming up in just a few weeks. And if you go, I'm sure you'll be able to see Sam there in person. Well, Sam, as always, it's great chatting with you, and I'll be seeing you in a few weeks at the conference.
Sounds good, Bill. And I'm on a panel with Brent Cook on Tuesday afternoon. So come and have a listen.
For millennia, ancient pharaohs prospered from unparalleled riches made possible by Egypt's resource-rich gold deposits. But despite this rich history, modern Egypt remains one of the most underdeveloped gold mining countries in the world. But that's all about to change. Aton Resources is leading the charge on the Egyptian mining revival. As the only public exploration company in Egypt, Aton Resources has first-mover advantage. Focused on their 100% owned Abu Marawat concession, Aton Resources is advancing several exploration targets, including the recent discovery of the legendary Lost Mountain of Gold at Rod Ruin. Learn more about this exciting drill program and other news at atonresources.com. Aton trades on the TSXV under the ticker symbol AAN and on the OTC under the ticker ANLBF. Thank you for listening to this Mining Stock Education podcast. Please subscribe and share with like-minded investors. Visit us on the web at MiningStockEducation.com for more resources on precious metals and natural resource investing. At our website, you can also sign up for our free newsletter for interview transcripts, stock picks, and more.